Hey everybody, welcome back to the Perfect Portfolio. And I'm super excited about our guest today, but everyone keeps asking me, Mark, where have you been? I haven't really been on Instagram or YouTube. And that's because I've been finishing up the book. I've talked a little bit about the book that I'm writing, which is about being smart and paying no taxes. And I'm proving in the book that anybody of any income can do it. Now, the book's written for construction workers and HVAC workers and just regular folks. And I'll prove within the book that anyone can use the buy, borrow, die strategy, build wealth, pay very little taxes, retire tax-free, and die with no taxes. So, anyways, I'm back here with the perfect portfolio, and I'm very excited about our guest today, who's Dave Mazza. He's actually the CEO of Roundhill Investments. And Dave, welcome to the perfect portfolio, man. Excited to have you here.
Yeah, I'm excited to be here. Thanks for having me.
Great, great, great. So, first of all, I've been following pretty much. I mean, I've been studying. I mean, ETFs for obviously a very long time. I was an investment advisor for 15 years. Before that I was an options trader. I learned what a covered call was like 24 years ago. And I've just seen the innovation. I'm very excited about what you guys are doing because I've seen lots of ETFs come around in the last 3 years specifically. Like it's been a covered call innovation battle, right, for the last 4 years, I'd say, something like that. And I've seen some create and they just flop and they like die and fizzle because they weren't designed right. And I've seen some do well and some have things, but it's just awesome to see the innovation because if you guys are innovating, you guys are competing, we're disrupting. I think we're all winning as investors and from there. So maybe just tell us a little bit about yourself. I just want to learn, Dave, where were you born? Where were you from? What'd you do? Where'd you grow up? All that stuff. We'd love to hear from our audience. Would love to hear who you are.
Yeah, so Dave Mazza, as noted, I presently live in Los Angeles, but I'm a Boston boy through and through. Grew up north of Boston, spent a lot of time skiing in New Hampshire and Vermont, which is a passion of mine. Went to Boston College, so like I said, very deep Boston roots, which I sometimes try to bring out here to Southern California. But when I think about my career, I had the benefit of starting at State Street Global Advisors, which is part of State Street Corporation. And it's interesting when you talk to a lot of young folks when they're starting out in their career, it's really challenging. One, from a job perspective, and everyone wants to get the right position, and you're told to get the right internships. And I'm not saying that doesn't matter; it really does. But the benefit that I've had, and some of this is hindsight, is that in my career, I particularly in my early days in my 20s, kind of had an opportunity to move up the ladder, but do so sort of in a non-linear way. So I actually started my career at State Street in a business called Charitable Asset Management, which manages gift annuity funds, pooled investment funds, charitable remainder trusts. And this is a legacy business of that bank going back hundreds of years. And it was really neat because you get to sit at the intersection of folks trying to have charitable giving, but with vehicles like that, actually have income for themselves or for family members. Or in one case that I'll never forget, actually there was a carve out for expenses to be paid to somebody's dog. And then at the end of the life of that gift, the remainder would go to a particular charity. So it was a really neat, and again, I'm blessed for that experience. From there, moved to a quantitative portfolio management team where I've got a deep understanding of factor investing, risk management, stock selection. And after that, I moved into State Street's ETF business. I think, best known with Spider ETFs. And I actually, at the end of my time there, was their head of ETF research and strategy. Took a kind of another career pivot, moved to Oppenheimer Funds in New York prior to their acquisition by Invesco, and I actually led their ETF sales and marketing. So very different from my previous research portfolio management background, great experience. And then right before Roundhill, I was actually at Direction. So another huge departure. Really, those ETFs are focused on really leverage and inverse ETF tools for outperformance, for tactical trading. And then since 2023, I've been at Roundhill and was named CEO this year. And really part of our path toward continuing to create innovative ETFs that provide different outcomes for investors, whether they're kind of heritage and thematic equity investing, exposure tools like our Magnificent 7 ETF. And then most recently, which, the subject of today's conversation is what we're doing on the options income side.
Very cool. Very cool. Yeah, for sure. Yeah, it's cool you're from Los Angeles. I grew up mixing concrete and building chimneys in Los Angeles. I don't know. Maybe I built your fireplace when I was, I don't know. It's kidding.
Maybe.
Maybe,
We're fortunate to have a few here, but they are can be few and far between in this part of the country.
Oh, absolutely. Yeah. I left Canada. My family left Canada. It's Northridge earthquake. There was no work in Canada. My dad was in construction. He's like, oh, I'm going to go build chimneys in Los Angeles. And that's how my family ended up in Los Angeles. But finally left Los Angeles and we're out here in Tennessee. So let me ask you, like, so I grew up mixing concrete. Like I was not a financial guy. There was no financial talk in my house. Did you grow up around finances? Was that like talked around the kitchen table, or was you were the first one and really delve into finances? What did that look like for you?
So it's interesting. So most of my family is in, I'd say, the food business in some way, shape, or form. So for more than 20 years, my mother managed a local deli. This is a place.
I was going to say a deli in Boston, but
yeah.
I was like,
So maybe not a New York deli, but I think Boston
yeah,
delis are pretty good. And this is like,
yeah,
a cops and firefighter kind of place. And so
sweet.
we weren't talking about investing, but the nature of running a business like that is, finances matter. And my father, like many of my uncles, is actually in the fish business. So they are buying fish, from boats that catch it, and then selling it to restaurants or supermarkets. And so maybe more than I realized is that there was probably a thread of sort of finance numbers, if you will, all the time throughout my childhood, but not in a kind of traditional way that a lot of people would think of it.
Right. We didn't have the internet to go, oh, let's go Google how to investment accounts and let's take out our iPhone and invest, right? We just kind of had to, like, I don't know, figure it out, I guess, right? When was the first time you like invested? Do you remember that? Like, is that, I don't know.
I do. And I remember specifically, this was maybe I think it was my senior year of high school. I had been doing, I think heading into college, I had been doing landscaping, gardening jobs, nothing sexy at all. But you can earn some pretty good money if you're working with the right people.
Yep.
And I actually used a good chunk of that to buy two things, which maybe is boring, but at the time I thought it was innovative. I bought some treasury bills and at Fidelity Investments office, and then a couple of their kind of brand name, well-known mutual funds. Those didn't necessarily make me a millionaire at 18, like you hear about these stories of some folks, but it kind of, particularly during my college years, where basically all you're doing is spending money, a way to, or something to look at. Maybe it would be I think, a little bit grandiose to call it a nest egg, but it really was sort of transformative to kind of be able to. And then I remember checking at Boston College, like probably many universities, they have free Wall Street Journal and New York Times, and you check the ticker in the page just to kind of see how it was doing. So that was my first experience, but I think one that was very transformative for me.
Very cool. Very cool. So I was looking at your website. You guys have a huge team. I mean, it looks like you've launched like over 100 ETFs with your team there. I know you guys have over 20 ETFs. When did you start Roundhill, and what was like the inspiration to start Roundhill? What did that look like?
Yeah, so it's a really, I love Roundhill's story, and it's actually founded in 2018 by two gents, Will Hershey and Tim Maloney, and their thesis was that there was sort of a missing link, particularly between younger investors and kind of traditional financial services firms. And so they embarked on a path and had some success with launching, first to market funds with sports betting, the metaverse, video games. And it really, that appealed to a group of folks who maybe wanted broad-based exposures, but also wanted something that they felt more connected with without taking on single stock risk of just buying Roblox or just buying Meta. And so giving some diversified exposure to those themes. And then when I joined a few years ago, after sort of being connected and following the firm's growth, really is where we then took a renewed focus on where are the next opportunities for innovation? What are the other sort of missing product sets that even if one of the major ETF providers could do, they're just not doing, or doing in a way that we think we could do very authentically. And that's what we've, really tried to focus on the last few years.
Very cool, very cool. Yeah, I know income investing has kind of exploded. I'm personally an income investor. I don't care about retirement accounts. I would just want to know, build my income now and build passive income, and it's very much something we teach in the course. But again, I've seen all these ETFs, and some have high income NAV loss. I mean, it's just it's such a range, and it almost seems impossible to to see how it's going to work before you actually build it. Like, is there a way to, when you guys were building like XDTE, which is probably the one that I own myself and I really like, is when you launch an ETF like that, do you know how it's going to perform, or do you kind of have an idea of how it's going to perform, and then you just kind of see, after you launched it? What does that look like?
So I wish we would kind of be able to identify every product that would resonate with investors. But the way that I've always thought about it, and that we try to apply at Roundhill every day, is kind of the intersection of three components. One is the investment thesis, right? So if it's not in a sound investment rationale, you probably shouldn't be doing it. Then can we actually build it in a way that's going to deliver? Because a lot of great ideas, as we know, are just ideas, and they're actually not able to be implemented. And then lastly, do we think there's commercial appeal? Because ultimately that is what matters to an ETF. Obviously, you want the right outcome for that you're trying to deliver, but if people aren't interested in it and it never goes anywhere, there's not an opportunity for more people to engage with it. And that's really what we tried to do. And I think to date, although still relatively early days in the grand scheme of things after launching these funds in March, is try to kind of thread that needle where we know that there is, to your point, kind of a renewed focus on income, which I think is a good thing, coupled with the fact that when developing these strategies, there is a lot of trade-offs. But the main one is, how much income can I generate relative to what is my principal actually going to do? And what we did with these funds, XDTE, being a prime example, is it's intended to provide you with exposure to the equity market, but have attractive high income potential along the way, particularly with the weekly dividends that we have. And what's interesting about our strategies is that it's actually a daily covered call strategy. And so that means we're trading daily, but we actually don't cap the upside in the overnight session. And there was some research done in the 90s about this anomaly that's called the night effect, where actually over the very long term, most returns in the market, kind of contrary to people's maybe, at least before I was aware of this work, what I would think of is you think returns come from 9:30 to 4. Well, most of the returns actually happen when the markets aren't open, right? That's where corporate earnings occur. That's when most economic releases happen and events like that. So these funds are able to provide that exposure, which gives more upside than a traditional covered call strategy, but still generate that income by implementing the strategy again on a daily basis. So every morning is when we conduct those trades to do that, to cover the exposure.
Wow. Okay. So just for the people who are not familiar, basic covered call, index, sell a call option once a month. That's typically how it was done. Correct me if I'm wrong, that was like the first innovators. And then there was zero day selling options once a day was like this new innovation again. And then there was what are 1256. Yeah, how would you basically describe that? Because it's a very complex. How do you simplify XDT for me, for the person who doesn't have too much options exposure, if that's possible?
Yeah, no, and I think the one caveat I'll bring is that all this innovation is great, and I think when I hear personally, and maybe this is a personal opinion, of people trying to stifle innovation or saying that there's too much of it going on, I take offense to that. But the reality is that when you have more tools in your toolkit, more choices, it can be overwhelming. And to your point, investors really need to know what they own and understand what they're getting. But simply put, XDTE seeks to provide overnight exposure to the S&P 500 and generate income every day by selling out of the money call options, zero DTE call options in particular, on the S&P 500. So it takes that traditional covered call, whether they're monthly or quarterly, compresses the time frame for when that happens, but we don't give up that overnight upside potential.
Wow. Okay, good. So let me summarize this. You're selling options every single day. You pay income weekly.
Yes.
You have essentially, you somehow get around, you don't really have a cap because it's traded overnight. Is that right? Is that why you're getting more upside on the position?
Yeah, exactly. That's correct. So that has allowed us to date to actually outperform the index, which is contrary to many people's sort of assumptions or previous thoughts about covered call strategies, which I think is the real. There's a lot of innovations that we have here. Weekly pay is distinct, but I think the real benefit to an investor is that you don't necessarily have to give up your upside. Now, if we were in a sustained down market where every night the market was going down for months at a time or something, you wouldn't outperform, but you would still have the benefit of kind of the traditional covered call income generation.
Okay, cool. Yeah, for sure. And then you have are you targeting a dividend, or because again, targeting dividend could be NAV loss. And I noticed you guys have had no NAV loss, correct? Like since the fund started, you guys are pretty much no NAV loss since you started, and you're doing what's the current dividend, and you're producing no NAV loss.
Yeah, so the annualized distribution rate, which is effectively the dividend that folks would receive, is about 18%. The range from what we've seen on a weekly basis is, I'd say somewhere around that to maybe up to 25. But what we don't do, at least in this strategy, is target a particular level of income. The reason being, as you were alluding to, is that what we don't want to do is necessarily try to shoot the lights out on the income side, generate really, really high income at the expense of the total return potential.
Right.
And that's really the balance when we think about managing this portfolio. And again, on a daily basis, that's actually the needle that we're trying to thread, is saying, hey, if volatility is higher, that means that the implied volatility in option speak, the implied volatility is likely higher. That means you're going to earn more premium by selling that option to someone else. When it's lower, you're not going to be able to earn as much. So we move. Now I am getting into options land. Move the moneyness of those options really depending upon the market environment.
Oh, that's awesome. So, I mean, the fact is, I guess the kind of consensus argument, you just can't beat the index with a covered call, right? That's kind of been the thing, but you guys are doing it. I mean, that's kind of amazing. Again, it just proves that it's impossible to have too much innovation, right? Innovation causes you guys to get better. I mean, you guys are probably better because of something somebody did, and then you guys are all making each other better with competition, right? I mean, so I 100% love the innovation and disruption. Now let me ask you something like this. So XDT, no NAV loss, QDT, some NAV loss. Is that something you guys are considering? Are you looking at adjusting something there, or is that just the nature of the volatility of QDT versus XDT?
Yeah, it's more the underlying market. So I think I think everyone would love to have that kind of holy grail, right? And some folks see our returns and say, this is the holy grail, right? And I want to caution against that, because while we are proud of our returns and we are very pleased that investors have come to embrace this, we're not guaranteeing anything. This is still an equity investment, but we're transforming the returns for you from just reliant on, particularly in the NASDAQ or in tech stocks or small caps, which is our most recent launch, RDTE. You are still exposed to the market. In the case of the S&P 500, you have been in this really interesting environment where you've benefited from that overnight effect, where volatility has been lower, so the income is slightly lower, but you've benefited a lot from that capital appreciation potential.
Yeah. Yeah. I was just looking at the graph today. You guys are beating the S&P 500 by quite a lot. I'm like, that's pretty amazing. And you guys are doing it with less drawdown. I mean, it's just, I don't know. I think it's a pretty awesome ETF. I've seen, again, I've interviewed, some of the other, I guess your competitors, and we all know who they are. And, you guys are creating amazing stuff. So, I love the innovation, love disruption. In fact, if it isn't innovating and disrupting, I probably don't want to have anything to do with it, right? But if you take XDTE and you use buying and buy, borrow, die strategy, it gets even more fun because you can buy XDTE, you can margin it, you can borrow, 40% more, and then you're going to crank, you're going to destroy the S&P 500. So when people go, you can't beat an index fund, well, take a fund that is beating the index, use a little bit of margin, and I'll give you that. Leave that out for some tip on there, and then of course never sell the position, and then just take loans and live off the borrow button. We actually talk about that in the new book, and I like your fund so much. I'm going to mention your competitors, but I'm also going to put you guys in the new book. I think you guys are innovators and disruptors, and I just love what you guys are doing over at Roundhill. So thanks for jumping on the perfect portfolio today, man. It was awesome talking to you. And what's next? Anything great innovation that's coming down? And I know you don't want to tip off your competitors, or I know there's certain things you can and can't discuss, but what's next for Roundhill?
Yeah, as you know, there's only so much we can say, but what I can say is what we filed for. And so one of the strategies that we filed for is takes this options income idea and gets closer to that target income that you mentioned. So the idea with some of these new funds that we hope to launch soon is that we are saying at the beginning of the year that we will, provide a distribution rate of 10% or 20%. And still provide market exposure, but the return path is going to be different because in this case, they'll pay monthly. We're delivering you that return. So this is these funds are more geared towards someone who is very much income first and is maybe less concerned about NAV growth or NAV erosion. But I do think they could be very powerful for someone to say, hey, this is my objective. I'm going to choose this particular strategy, or I want to have something that's going to have maybe slightly more variability in its income, but provide me with, have the potential for that capital appreciation too. So a different take on the strategy, but one, again, giving choices to investors. And we've heard great feedback from conversations like this and from the rest of I'd say the broader income community, which is very vocal about what they're interested in, what they're not. So it gives product providers like us a lot of great information to say, hey, is there something here? Is there an investment rationale that we believe in that we then can deliver a solution for?
Yeah, well, I can tell you for one thing, we all want total return. We all want income.
Good. Yeah.
And we all want less volatility, which I think you guys are nailing it on all three, right? You guys have less volatility, less drawdown, total returns, awesome. And I think you guys are killing it. So, hey guys, congratulations on XDT. It's pretty big, right? How big is the fund right now?
We just crossed over 150 million in assets, which is great.
Okay.
And right around 170 today.
All right, for anybody who's listening, go buy this fund. It's literally, I've looked at them all. It's a pretty amazing fund. And like I said, we're going to plug it in the book, Dave. Thanks for your time today, man. Thanks again. And thanks for innovating, and thanks for being on the channel for the perfect portfolio today.
Hey, thank you so much for having me. I really appreciate it.